Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Starbucks, wanted to take a look at these guys because they were down about 17%, and whenever a big name like Starbucks drops this much, gets you pretty close to 2020 COVID lows, not quite there, but maybe we'll get there eventually because the results were terrible. The call itself was terrible. I am not at all impressed with what the CEO had to say, what the team had to say. There was a bunch of technical difficulty towards the end of the call, so you couldn't really hear the answers to the questions the analysts were asking, but the CEO went on some talk shows after the call, and he was terrible on those two. Like, it just doesn't have a good answer to what's going on. The call itself was very much a blame game. It's like, this is the problem. It's not Starbucks, it's other external factors that we can't control, and we're improving on them. So it wasn't like a mea culpa of this is where we went wrong. It was more of a stuff, outside of our control is happening, but we're working to fix it. So look at the results themselves. Revenue actually down 1%. I think the expectations for the year as a whole was about 7 to 10% growth. So to be down 1% is kind of a big deal. Force them to readjust their guidance for 2024 to be more in the single digits, down from that 7 to 10%. And a lot of that is driven just by lower demand. Comparable store sales are down 4%, and that's driven by a 6% decline in comparable transactions. And really, they've always had a long-term goal of about 5% comparable store sales growth. And I think that's kind of a question mark at this point. If you talk about, hey, this is a company that's grown in the 10% range for a while now it's growing in the low single digits. Is that the new norm? Is the demand really falling off a cliff here? And they talked about a variety of things that are driving the lower demand. They mentioned a 3% impact from severe weather, and I was like, what the hell are you talking about, severe weather? What's severe weather? Nobody else in this industry is mentioning severe weather as a headwind. And then on top of that, they mentioned a headwind that there's too much demand in the mornings and people are actually canceling 15% of their orders in the app because there's too much demand. Really now, I mean, maybe that's really why they're canceling, but I think part of the problem here and part of the drop off in demand is that Starbucks has hit a point in their pricing where it becomes easy to just say, I'm going to go somewhere else. I'm going to go to a local coffee place. There's a lot of competitors even in the big space. You talk about Dunkin', you talk about the expansion of Dutch Bros. And now that this price point has hit that level, maybe the people go into the app and they look at their latte being $7 to $8 and they're like, maybe not. Once you pass a certain threshold, maybe people were getting a coffee with a muffin. And once that threshold passes like $10, people start saying, I should probably do something else with my money, especially as the economy does tighten up. And they mentioned the economy tightening up, and I don't know if that's really there yet. I think people are just saying that maybe I'll spend my money on other stuff. They're not necessarily pulling back because the companies that have mentioned this economy tightening up and people pulling back, Starbucks, McDonald's, etc., they've just been raising prices too much. That's my opinion. You look at a McDonald's meal these days, and it's like comparable to a sit-down restaurant. That's a problem. You look at Starbucks and you're paying $8 for coffee, you're paying $7 for some fruity drinks, and they can say, yeah, we had a successful launch with some lavender drinks and other stuff, and we had this other launch that was successful. There was too much demand for that thing, and we didn't have the capacity to fill it. But at the end of the day, if the price structure isn't there, it's going to be a problem. And if you look at Starbucks and how they raised prices between 2014 and 2019, they raised prices by about 10%. So Starbucks was already kind of expensive in 2014, but it was kind of an expensive treat because the quality was there. The store experience was pretty good. Then they raised prices by about 10%, kind of keeping in line with inflation. It was still a reasonable price point. But then once you hit 2020, they started raising prices much more. And again, inflation was there, so it makes sense why they had to do it. But I think they did it a bit too much. They should have pulled back a bit, not scare away the customer, because their prices since 2020 are up 20 to 25%. And once you reach that threshold where the customer is questioning the price value, and they mentioned how the customer still thinks it's a good value, and on the call they mentioned value like 15 times, but is a $7 to $8 cup of coffee really a good value, or are people just going to go elsewhere, make coffee at home, and spend money on other stuff? On top of that, people aren't going to the office as much anymore. A lot of stay-at-home people now these days, and that obviously impacts their business model because people would pick up a cup of coffee on the way to work. And now that they're home, most of them probably aren't going out the door in the morning to get Starbucks only to bring it back home. They'll make coffee at home. My wife always made coffee at home. I'm not a Starbucks drinker. Like, we'll get something at Starbucks maybe once in a blue moon when we're at an airport, but we never go out of the way there. So at the end of the day, I think that's the problem here. The problem is prices are too high. They should have mentioned that on the call. They should have said, listen, we have raised prices a bit too much and we have to pull back. Because if you look at their earnings in the last couple of years, they just went too crazy with it. 21, obviously a year against COVID, but up 23%, up 11% in 22, up 11.6% in 23. They're growing at a faster clip than they were growing in 17, 18, and 19 because they're raising prices by 5 to 6 to 7% every single year. And that is going to catch up with you, and it has caught up with them. I think that's my concern here if I were a long-term shareholder. One, the CEO kind of sucks. Two, are they pricing themselves out of growth in the future? Because yes, they're going to open up a bunch of stores. They opened up 360 new stores in Q2. They already have 39,000 stores. They have a long-term goal by 2030 to open up to 55,000 stores total. So, another almost 17,000 stores, up to 20,000 stores in the United States. Right now, there's about 16,000. So obviously still some momentum to grow. But how many Starbucks stores do you really need in the United States? How much cannibalization is happening when those stores are, 5 feet away from each other? The competition is getting stronger in the US and in China. There's a lot of price wars in China right now, so they're struggling in both markets. And they are saying that this is a short-term thing. They're going to get back to their sillily named triple shot with 2-pump strategy to elevate the brand, to strengthen and scale digital, to become more global, to unlock efficiencies, to reinvigorate the partner culture. But at the end of the day, 55,000 stores globally, certainly going to grow more from here. But how much of that is going to come from same store sales growth, which is very important for a business like this, right? You can always raise prices more, but if that drives people away from your store, that's going to be a problem. So Q2, not a good sign for long-term investors. I would be eagerly awaiting seeing what happens in Q3, in Q4, because obviously they're down about 1% or 2% in Q2. That means they're probably expecting some sort of growth in Q3 and Q4 to get back to the guidance that they gave of low single-digit growth overall. Some of that is going to come from the new stores that they continue to open, but how much of that is going to come from growth in same-store sales? Because at the end of the day, at today's price point, even after the 15% drop, I think this needs at least mid-ish growth from the same store side to continue being valued fairly at today's price. So if you're talking about same store sales that are declining or growing at zero, that's going to be a problem for investors because you're essentially going to get 2 to 3% growth just from new stores. You need more than that, and I think that's a problem. So I'm looking at the valuation here. Disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence. So again, even after the drop, this is an $84 billion market cap company with about a 4.5% free cash flow yield, 4.3%, something like that. Again, Starbucks has always been valued aggressively. This is probably as affordable as it's been in quite some time in relation to their historical earnings. Obviously, this is a company that even during the pandemic was able to have positive free cash flow. So historically has been relatively safe as an investment. I think that's why people buy into it. They use that free cash flow to pay a decent dividend. Now it's up to 3%, but also to buy back shares. So I think that's going to continue. I'm assuming about a 6% dividend growth for the next couple of years. I'm assuming about 2% revenue growth this year with 8% free cash flow margin. Again, their free cash flow margin is already negative in Q2, so I'm expecting that to kind of return to norms in Q3 and Q4. Not anything crazy here. This is kind of the norm. I think some of these estimates that you're seeing from analysts are going to come down in the next couple of weeks. And then as I look at 25, 26, 27, 28, I think these estimates of, again, high single-digit growth, that assumes 4 to 5% same-store sales growth. Do you think they can reach that? I think that's going to be a problem. If you look at their Starbucks Rewards members, yes, they were up 6% year over year, but they were actually down about 2 million in the last quarter sequentially. So if you look at Q1, they had about 34 plus million Starbucks Rewards loyalty program members active in the last 90 days. Now they're down to 32.8 million. It shows that people, the most active people, are sort of dropping off. They're looking at this price point, they're looking at the products that they're offering, and they're saying maybe the value isn't there, even if the CEO says that the value's there 17 times during a call for one reason or another. And again, the CEO sucks. I think he's gonna be let go in a year at most. I give him a year at most, unless something changes. This was probably one of the least impressive calls I've heard in quite some time. One of the least impressive follow-ups I've seen in quite some time in terms of how the CEO explained the failures, because this is kind of a big failure. They just had an investor day a couple months ago, and they said, hey, we're going to grow 7 to 10%. And then suddenly, a couple months later, we're growing badly. Things are bad. The economy's bad. The consumer's bad. And again, I don't think the consumer is bad. I think their product offering for the amount of money they charged has fallen off. This used to be a coffee shop. Like in 2014, Starbucks, you would go in there, people would be sitting there. You would talk to the barista. They'd make you a nice coffee. Now they're just pushing everybody towards the app. They're churning through people. Nobody's really sitting there. It's like, come in, come out, get out, get out, get out, in, out, in, out. They're talking about automation of their processes. Maybe that's a thing that they can work on in the future. But at the end of the day, things aren't looking amazing for this company based on these earnings, and I'm not super excited about this. However, this is still Starbucks. They're not going to just disappear in the next 5 years. They're going to do okay. They're going to continue growing their store base, but maybe, just maybe, they'll start slowing down. This is a company where the expectations have been low teens growth for quite some time. And now this is a mature company with mature prices that probably can't raise prices too much more these days because they're already a bit high. And same store sales are probably going to slow down. So these analysts are saying, well, high single digits. I'm saying probably closer to 5%. You might have low single digit same store sales growth, and then you're going to open up a bunch of stores. And maybe these stores are going to be more overseas, and those stores are lower revenue drivers, lower margin stores as well. So that's going to put a bit of pressure on their growth on top of what we're seeing here. And then as far as the margin goes, I think, there's going to be some improvements. They're going to automate some stuff. They're going to become more efficient. More people are going to go in the app. They can upsell certain things, etc. They can probably sell higher margin products. They're releasing some new boba tea type stuff. There's always some innovation that they have going that might suddenly be popular or what have you. And then again, majority of their money, about 60 to 70% of their free cash flow goes towards a dividend. And then the other part, some of it will be used to pay back debt, and the other part will be used to buy back shares. So even as I look at this, again, historically, this is a company that has been priced in that 3 to 3.5% free cash flow yield area. So if you look at it from that perspective, if you think it's going to return to that, could be a really good value at this price point. But historically, it's also grown at a certain rate. It's also had certain margins. That growth rate is going to come down. Margins will probably stay about steady, maybe come down a little bit. I think the market's going to reevaluate this stock and kind of put it in that 5% free cash flow yield tier. It's still a good company. It's still Starbucks. It's still a marquee name. But if you're saying that this is in the 5% free cash flow yield tier and you're looking for a 10% return, you probably need a lower price point than this. Right now, I'm seeing this as about an 8.25% return from today's price point. Not terrible, pretty good. A lot of that is coming from the dividend, and some of that is coming from the buyback. You're still getting a 3% dividend that's probably going to grow. They've raised their dividend 13 years in a row. Don't see that as under threat unless this kind of pressure that they're seeing continues for the next couple of quarters. Maybe they'll kind of reset their pricing strategy, try to attract people who have kind of been priced out of their system, make for a better experience in their coffee place, and kind of return to growth again. But for me, I think that's a risky proposition, especially with this CEO at the helm. Maybe Howard Schultz will return again, who knows. So as I look at this at an 8.25% return, my target return is always a 10% return for a company like this. But again, that doesn't include dividends here. So I'm basically saying I need a 13% return. At a 13% return, the fair value I have here is about $59.23. If I put in 7% to kind of get to 10% return after dividends, you get a fair value of about $68. So really not too far off from where it is today. But for me, I just wasn't very impressed with what the CEO had to say. I wasn't very impressed with the returns that they're seeing on some of their investments in automation, in some of the new product launches that they've had, and how they're actually showing through in the results. and the results are just bad. It's hard to ignore bad results, and obviously the market reacted to that already. But for me, if I wanted to own Starbucks, which again is a good name, I think is going to be around, I'd probably need to get paid for the risk that I see ahead of this company with where the price points are, with where the consumer might be a couple of months from now. If they're talking about the consumer being weak now, what if an actual recession happens? The middle class is probably being impacted a little bit now. Are they going to be impacted a lot more? There's been a lot of layoffs in the upper middle class scale, and these are probably people that go to Starbucks. Are they going to ever return to Starbucks, or are they just going to get away from the habit of paying $9 every morning at Starbucks and do something at home? Because you can do what Starbucks is offering at home for a couple of bucks. You might just need to make an investment in a nice little machine, and then the coffee itself isn't too expensive. And I don't know if the experience that you get at Starbucks is worth it. And the coffee itself has just gotten worse and worse. And some of the product launches, who wants olive oil in coffee? That just screamed like a bad idea to me, and it's probably showing up in the results. And maybe they'll do something cool and innovative, and people will like it. But there's a lot of competition, not just from coffee, but if you want caffeine, you've got all these energy drinks that have caffeine in them. I think some of the younger people are kind of moving in that direction these days, Celsius, etc. So Starbucks probably going to see some pain ahead, and it's already showing up in the results. So for me, not a buy at this price point, but let me know what you think. Am I off on anything? Am I missing anything? Are you actually a fan of this new CEO, or do you think the same as me? Let me know what you think in the comments down below. Like, subscribe, and all of that stuff. Bye.